Welcome to the January 11th, 2026 edition of Market Thoughts. I'm Dave with Lighthouse. Let's get into what happened this past week and a big report coming up on Monday. Before we do that, what matters when you market 7, that is only 10 days out, January 21st, 2026. We've been talking about it. We've been excited about it. We hope you're excited about it. If you haven't RSVP'd yet, make sure you get it on your calendar. I want to just tease a couple things you're going to hear a lot about at that event, what makes it so unique. 2 problems that you have, that I have, one that we can solve together, one that we all need to collectively work together on. First, just price benchmarking. We're going to unpack this a lot further. Top 10% of Lighthouse clients on their 2024 corn average 503 futures, average of 477 for everyone, bottom 10% 452. Same info, same communication, same recommendations, 50-cent difference on price. Worth noting, beat the average of all farms using North Dakota and Minnesota Farm Business Management data, the average of all farms, several hundred in this control group by a wide margin, but still just a huge spread between top to bottom. We'll talk about why and what you can do different if you'd rather be at the top instead of the bottom. Another problem we have that's just like a lot of problems on the farm, it's a problem created because of your own success farming. North Dakota total corn supply, 692 million bushel in this year's crop, almost 100 million bushel than our previous record, more. Our previous record was the year prior, and more than double of what it was during the previous bull market. All of this with no increase in demand other than some marginal increase in shuttle loader shipping capacity. This is a problem alongside all the blessing that corn has been in North Dakota. So we're going to spend some time talking about just what has to happen in the state on the demand side if we're going to continue to grow corn, produce these kind of yields, see corn production increase even further. Those are the sorts of things that get covered on our meeting alongside networking, fun, all sorts of other things you'd come to expect at any meeting. So don't miss it. Get it on your calendar 10 days out. All right, looking at weekly changes, didn't accomplish a whole lot for March corn this week. Ended up adding 8.25 cents. Good enough, I suppose, but just puts you right back in the middle of this trading range. It's extremely well developed. You've got your triple bottom here at 435. You've got a couple of punctures up above 450, including a high of 457 very briefly back on the 14th. But mostly what you've done going all the way back to before Halloween is just trade in this same, the majority of this trading has actually occurred in about a 10-cent range. It's unbelievable how much consolidation there's been here on this corn chart. If you actually narrow this chart up, you can see it even more well pronounced. You've just spent most of your time the last several months in a pretty tight range. Will that change Monday at 11:01? We'll talk about that more in a second, but that's how it is leading up to it. Just need to change this chart. I must not have saved it after last week. We need to be looking at March here now. This is March beans. If we look at a weekly chart, actually added 16.75 cents on the week. You're still very much in an overall downtrend going back to your highs back in mid-November, but here's how the daily chart looks. You pierced down a week ago Friday, first trading day of the new year, apparently some pent-up selling that wasn't done yet. You made this hammer low, this spike down, and then back to close near unchanged. Sharp gains to start the first full week of the new year, and you've trended higher all week. You had 3 of 5 days were higher closes. You closed the week well off your recent lows. This is still not super warm and cuddly as far as a major low being in place, but it fits with what you want to see. It'll be imperative that early next week you make a new recent high, that you get above this 1070 high from Wednesday of last week, which means you got to get through that Monday report without any bullish, without any super bearish news, but that's a given anyhow. So that's what happened there. Wheat, we continue to consolidate officially, but actually from a overall standpoint, from a weekly close standpoint, this is actually your lowest weekly close of the entire data set, but you can see the vast majority of the past several months, your closes have all been between 567 and on the high side as high as upper 570. So you're still, this is not a real friendly look overall, though. You're still mostly consolidating with a lower bias here. You're headed back. We've been talking about our daily emails. You're headed back again to test these contract lows. We think they'll hold. We'll find out soon enough, but still just ugly overall look on wheat as we head into this report. So that's what's happening price wise. January 12th, Monday, at 11 o'clock is the biggest report day of the year. It's the January WASDE report where you get your final look on production and you get a bunch of demand revisions alongside that. And then you also get your D-SWAN stocks, which is significant too, and probably one after the SEP1 stocks, your final stocks number, you see if there was any lingering change as you transition from old and new crops. So you get all this data, just find out where you're truly at in the markets. It's a volatile report day. Last year was very bullish for corn. We've seen it go a lot in both directions, but in any event, it's a big report day. So most of the time we want to spend it, or all the time in this commentary, is on what we think heading into that report, and most of it centers on corn because this is where we've got the most to talk about, where we think there's the most potential for uh, surprising numbers, if you will, to use that term. And it's also where Lighthouse's conclusions are the most out of step with just analysts in general, other trading companies, etc. So this is what the trade thinks going into the report here. And again, I'm going to focus mostly on corn and beans, or solely on corn and beans, and primarily on corn. So looking for, in our December WASDE, you had an unchanged 186 yield. Trade's looking for anywhere from 186 to 182, with 184 being the average guess. So looking for a 2 bushel cut in yield, having that translate to looking at a 50 million bushel roughly cut to ending stocks with a low of over 225 million bushel cut, a high of an actual increase of a couple 100 million bushels. So pretty wide range, 500 million bushel nearly range on your old crop stocks to use estimates. If we look at soybeans, it's a little tamer, 53 bushel yield, 52.7 is the average trade guess going into it, 53 unchanged is the highest estimate, 51.9 is the lowest. You're looking for a carry out range of 245 million to 350 million versus 290 million in the December WASDE. So you have a little tamer actually expected outcomes on your soybean numbers going into the report, not potentially as much volatility just based on as where the pre-report estimates are. All right, so let's unpack what we think on corn going into the report. I think you have a couple things. If we look at this yield number, we're not, so a lot of the average guess is 184, a 2 bushel cut, lows down to 182. A lot of just the Twitter crowd, social media crowd is throwing around numbers lower than that. Probably our biggest reluctance to get on board with these lower yield numbers is just we subscribe to Crop Profit. They have very comprehensive yield analysis, the main part of their service, and they're actually not seeing this at all in their final yield estimates that go back to the 15th of October. So we're inclined to actually have a hard time getting them on board, even with the 2 bushel cut, much less anything like a 4 bushel one. Worth noting, the largest Jan 1 yield cut ever has been 3.8 bushels a couple times. So if you're on the low end of this estimate, you're looking for what would then become the largest cut ever in the January WASDE. And again, this could look foolish. Our thoughts here, this last couple sentences come 11:01 on January 1st or January 12th, but that's just what the data says. If you look at just how the cash market's trading, also, you don't really have basis that would align with what this means for balance sheet if your yield was actually all the way down at 182. So we actually wouldn't even be shocked if this yield came in unchanged on Monday at 11. The other side of this then is on the demand side, and this is where it gets a little more interesting. So corn export sales, you had a really goofy holiday week export report here that was quite small, but even with that, you're running 200 million bushel ahead of the pace the USDA is currently at, which would itself be a record pace of 3.3 billion bushel annualized and whatnot. So there is room on the demand side to increase this old crop corn export number. In fact, if we continue at this pace much longer, almost certainly we'll have to increase the old crop corn export number. That would, you're not going to see this 200 million bushel increase on Monday's report, nothing even close to it, but you definitely have an upward bias in exports. And you also have what's still, we've been highlighting this for weeks on it, a very tight world corn stocks to use. So it's not out of the question that you hit, that you can, it isn't necessarily that you're front loaded on exports. U.S. corn still prices in competitively all over the world. You have a tight world carry out. This is a very strong demand number. The counterweight to that is we've highlighted the livestock residual number is clearly overstated. You're looking at a 6.1 billion bushel livestock residual number. That's 400 million bushel higher than the largest number you've ever had when your livestock units are actually not even close. We highlighted this a few weeks ago, and we'll highlight it again after tomorrow. So this is where you kind of land on some balance sheet scenarios and then what it means going forward. If you use kind of an average estimate coming away from this, that you just have minimal tweaks to demand and minimal tweaks to yield, a 1 bushel cut to yield, carryout remains unchanged, 12.5% stocks to use. If you think about our price to stocks to use modeling, that keeps you kind of right in the range you are right now, and it would fit with how we've been consolidating for so long. Here's how you get a bullish scenario. We don't think this plays out, but it's not. If we're wrong about all this, you can actually stumble into a pretty bullish scenario pretty quick. A 184 yield with no demand changes, just exports stay at 3.3 billion, livestock stay at 6.1 billion, or conversely, no yield change with a increase to exports, et cetera. However you back into it, if you were to come in towards the low end of those carryout estimates, that's at a 10.6% stocks to use. That gets you on the cusp of a whole new pricing paradigm that's supportive of a much higher move in prices. That would suggest more like a 485-ish midpoint of your pricing as opposed to 440-ish, which is what you get with the 12.5% stocks to use. So this is the scenario that would be bullish, that would break corn out of its range higher. We don't think it's as probable that we get that tomorrow. But if you do get a 2 bushel cut to yield and don't tinker on this demand, you're in a much more bullish scenario. We just don't think we're going to get this yield cut tomorrow. If you leave yield alone and we took it out of exports, but actually it should have came out of feed residual, you start actually cutting this feed residual number, you actually can start backing into an even more bearish carry out and whatnot. So, but this middle of the road, we think actually the middle of the road outcome is most likely that we probably end Monday similar carry out to what we went into Monday, just as goofy as that sounds. And then final takeaway is just, what do our analytics say going into it? If you look at, you've got a signal of 53, market gauges of 51, 50, 32, 42, 53. In other words, you're not getting a lot of help on your analytics. These are all neutral. These are all just middle of the road. Seasonal change, you do have very strong seasonal. You have a strong tendency for corn to rally right now in the short term. So this is a pretty neutral analytics view, but this is maybe a good time to just revisit our deep learning on our analytics. So our classifier model, disregard the pretty paltry graphics here. This is meant for internal consumption, so we haven't dressed up the graphics and whatnot. But basically, our analytics focus the last several months has been to take the data we just looked at, what we've just shown you, what we've used to great success for the years, our signal and our market gauges, and say, what if we use deep learning to do pattern recognition of this data to say what time frames are the most similar to the analytics we have right now. If we do that for corn going into this report, the highlighted orange time frames are the ones most similar, and you can see here, 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 and here, 4 of these 5 time frames featured large decline. Only one featured large rally. On average, the days most similar to right now, analytics-wise, going into this report, only 31% of them had a higher price 20 days later. The average change of the days most similar to these days was a negative 11 cents over the next 20 days. So our classifier data, our deep learning on this would say it's most probable that you actually have a slightly negative outcome on corn. So that's where we land on corn. We again, this is not a gut feel thing. This is our analytics, our crop, or not ours, but Crop Profits analytics saying this yield is actually believable at 186. Our data saying this is a neutral bias going into the report, and our classifier saying The other times we've had this type of neutral bias, this type of data output, corn actually fell in the short term. So that would be our takeaway. If we just pair that with some real world dynamics, if we are in fact right, I think you're limited on your downside. You're not talking severe downside. You're limited to, if anything, what would be a logical downside target would be to go back and test this triple bottom. It probably holds up. We've had much bigger carry out numbers through this stretch than we have now. Even the market still said, nah, March corn, we need to be around 440 most days. That's where we find demand to keep it moving. If it falls below that, we can't get guys to sell it. So generalizing there, but we think the most likely outcome would be neutral to maybe you go test these lows. If we're wrong about all this, you're going to break out higher and reset pricing to correspond with that tighter stocks to use that we talked about. So that's what we think going into it. If we were to just, that's the bulk of our analysis here. Soybeans are much more simple to just draw a conclusion on, mainly because if we look at our soybean analytics, their supportive signal has found its way to 50 now after being below the buy threshold on lows a week ago. But if you look at your market gauges other than SpecNet buying, you're at 17.0, 28.37, your strongest seasonal of the year. So we don't like hedging soybeans in here regardless of what we would learn or not learn in Monday's report. The analytics don't support it well. And there's been a real consistent bias the last few years for soybean yield to be reduced more than the trade thinks going into this report. So if we get a reduction in soybeans, that would even help offset your if you do have a cut on the export side, and it's likely going to keep soybean balance sheet similar to where it is now. So we don't think it's likely that you get a super bearish soybean report no matter what. And our analytics say we don't want to be hedging soybeans ahead of this regardless. We think corn will actually carry the water. I think this corn balance sheet news is going to be way more indicative of how we trade coming away from it. And that has us some comfort to stand by on soybeans and look at what we learn on corn numbers. And as always, everything we just shared here could be completely useless and irrelevant. We'll get the numbers, we'll digest them, we'll have a lot more impactful discussion in next week's market thoughts when we talk about the numbers we actually got, what that means, how it fits alongside everything else, and what we do next going forward.